when I was talking about the ugly stuff, right? I want to show you, this is Sean's actual returns on investment per property from years 2014 to 2021. This does not include home price appreciation. This includes everything else. So your net rental income, your tax savings, your principal pay down. It includes all of the costs, including maintenance costs, vacancy costs, tenant placement fees, all of that it includes. So this is what it really looks like in a number sense to be a JWB client for 10 years, and this is just the last 7 that we have here. All right. And these percentages should dictate to you, right? Did we overperform or did we underperform? And in my form, true to my form, I focus on the worst parts of rental property investing because I want to prepare you appropriately when you get into this asset class. So what I've done is I've highlighted the years for each property where we underperformed and sometimes grossly underperformed, right?
Yep.
And I think this is important because as a rental property investor, you need to be prepared that these negative things are going to happen. And each year, if you own 6 properties, it's going to happen probably once, twice. Sometimes you even have multiple that happen in a year. But generally, if you average this out, it comes back to that 3 property rule. That's why that 3 property rule is in place. You have 3 assets. 2 are going to be overperforming. 1 is going to be underperforming. And those returns are going to even out and hopefully slightly beat what you were expecting when you initially came in.
There you go. And we're going to get back into this slide, right? But we just wanted to show this visual here of, you see all the yellow, those are years that properties underperformed, and you see them stacked in different patterns. But when you look at the overall performance of the portfolio, it is largely positive, right? That 2014 year was at just 2%. And then 2015 and on, it's 15.8 plus, including some years that were, 30.63 and all this other good stuff, right? So just wanted to clear up this idea that I wanted to give away the ending of the story so that we don't get too distracted on, like, did this actually make any money or not, right? But as we go back here, you want to kind of talk me through some of this stuff, GC? Like, how should we look at this chart, right? Like, I see one year where 4 out of the 6 kind of like weren't great. Mm-hmm. I see another year where 2 of them weren't great. And then after that, it's like one of them wasn't great per year, but then there's a couple of years where everything looks really awesome. You want to talk to me about that?
Yeah, absolutely. So I think let's take a look at the most negative items, right? So 2019, property 3 is a good example, right? Again, it's surrounded by a lot of positives, but at the end of the day, this was a tough moment for Sean as an investor on that specific property, right? Now, that property had a property turn of $3,000, cost $3,000 of his money to put back into shape. That's more than the average. So it was a more costly turn than we expect. And that property took 5 months to rent out. The average amount of time it takes for JWB to rent a property out is 40 days. It took 5 months to rent this property out. Now, I share this with you in full transparency. I want you to see what can happen because I want you to be able to handle it. But at the end of the day, not normal, but it can happen, right? So in this worst case scenario there in 2019, if you don't have the right mindset, and this is something Sean and I talked a lot about early on, right? If you don't have that mindset, you could have a property where you have a 5-month vacancy and an above average property turn. You say, oh man, that's it. I'm throwing my hands up, right? I'm done with this one, right? But if you're not looking at a portfolio, if you don't have access to information like this, you could be making a really poor decision. One of the things I want you to see is that at each one of these really negative events, usually it's surrounded by some really overperforming years afterwards, right? If we're looking at 2019 property 3, negative 24%, it's surrounded by 27% in 2020 and 35% in 2021. Why do you think that is, Pablo?
Because it overperformed those years? I don't know. Oh, because it was fully rented out and it didn't have a vacancy.
Exactly. Fully rented out with a long-term lease and it didn't have a vacancy, right? So when I talk about this individual property being an inconsistent asset, it is, right? And each one of these properties right? The highs are high and the lows are low, right? So, and then the other thing is when you have a negative item, you usually are surrounded right after that. You have 2, 3, 4, sometimes 5 years of above average returns. What this should communicate to all of you is that if you don't have a strategy of having long-term resident stays based on long-term leases and renewals, you don't have a shot, right? Look in property one, right? So 2015, we had 6%, not a killer year, not a dud for a year, right? But right after that, 31%, 31%. In 2018, right? 5%, not up to expectations, not the worst thing. But right after that, 32%, 35%, 35%. In 2016, property two, right? We'll go to 3% for that return right there, followed by 35%, 35%, 23%, 33%, 35%. So I want you all to see this is the life cycle of an individual property. And there's nothing that property manager can do to eliminate that down year eventually. Like your resident is going to lose or to move out. But there's a lot that they can do to make sure that between those down years, you have 4 good years or 5 good years. Because if you only have 1 good year afterwards, it's not going to be enough to offset and hit your overall return on investment.
You know, GC, when I look at this chart, I think of the conversation we had last Thursday when Brandon was the guest on the show, and he was talking about this idea that every one of these properties represent a chance to get on base, right? Like getting on base means you're going to get home eventually. Some of these properties are going to be singles and doubles. Some are going to be home runs based on what the forecasted ROI is going to be. And you're just not really sure which one. So it's really just about getting people on base because eventually they're going to get home. And when I look at this, I would imagine that most of these properties had a similar ROI and outlook, because I know that for JWB, they're all widgets. You're selling the ROI, you're selling the cash flow, and it's always really standard. And then you look at, you know, this one that had all these years in a row overperforming and one bad one. Then there's one that had 3 down and 5 up, you know, and then, you know, so you see this variability, and it's really just about kind of like getting in the game, being open to the positive stuff while allowing for that mitigation of risk and consistency to do its thing over time.
You're absolutely right. Get in the game, make sure that the assets pay for themselves, and then hold on for a full market cycle so you can benefit from all 5 profit centers. Because keep in mind now, this is all profit centers, not including home price appreciation, right? Do you think that that has had a significant impact on his returns, knowing that he invested in 2012? And since then, you know, our appreciation rates have been much more than the historical average. Of course it has, which we'll get into. I'm sure you all would have assumed that I would shed some light on that.
I would assume that there's a slide somewhere around here. Is this it? No, this is total annualized investment.
Yeah, but this is important. I just want to shed light on this. So
yeah,
this is that portfolio mindset that I challenge all of you to have with your rental properties. Sean has this. It served him very well. When he had a negative item, when he had, you know, negative 24% returns in 1 year, he didn't call me up and say, Greg, I want to sell my portfolio. You know, he said, you know what, that's going to happen sometimes. What's my overall portfolio return? Are we hitting return expectations? And we are, right? So this 19.47, that takes every property, the weighted average annualized return, which is something that we produce for every client on a monthly basis, so that you can see, are we hitting the portfolio annualized return on investment expectation? As you can see, when Sean made his investment decision with us, we told him to expect about an 18% return. When he bought these properties in 2012, we are at 19.5% returns. Again, not even factoring in home price appreciation yet.
There you go. And now, by the way, Ken Milleen had just asked if this included home price appreciation. Oh, well, we're still not. There it is. The total with home price appreciation. There you go. 27%. Pretty significant.
Yeah. Yeah. And, you know, your net rental income right there, $127,000 over 10 years. That's like your dividend income. It's probably what you're not getting in the stock market. So that by itself, incredible. Takes into account all the expenses, any fees, any tenant placement fees, property management fees. So that's that. Your total return right there, that 257,000 and change right there. That includes your tax savings and your principal pay down. And if we take home price appreciation there on top of everything else, the overall return on investment, 27%. His money has been working at a 27% return year over year over year for Sean. And he also achieved passive income and consistency in the face of all these negative items, even in that 1 year in 2014, right? So the greatest harm is if we hadn't had this conversation early on and Sean didn't know this in 2014. What if he had thrown his hands up and said, man, I'm done with this asset class, right? That's where a lot of rental property investors find themselves because they don't understand how consistency really works.